చూసుకోండి. Good evening, madam.
Good evening, sir.
Good evening, madam.
Good evening.
Ask any students to join in the groups.
Okay, sir.
Good evening, Kiran, Jani sir. We'll be able to.
Yeah, hi, good evening, sir. How are you?
Good evening, sir. Good evening, sir. Very nice connecting with you, sir. We will start in another 5 to 6 minutes, sir.
No problem, sir. Fine.
Thank you so much. Thank you so much for that.
Thanks.
కానీ పెట్టుకో ఒక్క నిమిషం ఎవరైనా వచ్చారో లేదా చిన్నపిల్లలు
So, good evening to our esteemed participants of this FDP on India's financial markets, teaching, practice, and research perspectives. And good evening to our esteemed resource person of the day, Mr. Kiran Jani of Jainam Broking. Very good evening, sir. Are you able to hear us, sir? Our esteemed participants of this FDP on India's financial markets, teaching, practice, and research perspectives. And good evening to our esteemed resource person of the day, Mr. Kiran Jani of Jainam Broking. Very good evening, sir. Are you?
Yes, I can hear you.
Yeah. So, good evening once again, sir. I am very much, we are very much happy to host you today, sir. We are in the fourth day of this program. We have heard from experts from academic fields and research fields on how this, what type of research can be done in the Indian financial markets. And one of our experts have given a bird's eye view of Indian equity markets. And now we'll be going ahead with this, how a trader approaches this India's derivatives markets or F&O segment. As you know, this is a vast ocean, and we'll be able to give us some part of it and have a view of overall view of it, sir. Now I request our coordinator, our Josna Madam, to give a formal welcome to Mr. Kiran Jani of Jainam Broking.
Yes, sir. Sure, sir. Good evening to one and all who are all presented on this online platform today. I welcome all the participants, dignitaries to this online platform today for participating into FDP fourth day session. And this is the time to introduce our today's resource person, Mr. Kiran Jani, sir. Sir, most welcome, sir. On behalf of Department of MBA, Narayana Engineering College, Nellore. Okay. And this is the, sir is graduated from Veer Narmad South Gujarat University, Surat. And sir is strengthened in commodity analysis, equity analysis, financial reporting, finance and accounts, management reporting, audit and taxation, cost analysis, investment advisory services, etc. And Sari started his career as assistant auditor in Javeri and Company, and then worked as a technical analyst for Divine Fin Corporate Services, one of the leading share and commodity advisory company. And then Sir is worked for many companies like Azit C. Mehta Investment Intermediaries Limited, SMC Group, JM Global Equities Private Limited as associate technical analyst, and then worked for Kotak Commodity Service Limited, Rockstar Capital Company, Axis Securities Limited, etc. Then currently, Sir is working as a head technical research for Jainman Sri Consultants Private Limited. And coming to the specialities, chart pattern reading is a technical analysis and options trading and fair understanding of macro, micro fundamentals data, etc. Finally, we can say about Sir. Sir is having 10 plus years of experience in commodities and equity research, and 3+ years of experience in accountancy and taxation. That's all about our Kiran Jani sir. Thank you, sir. Thank you for spending your valuable time, and that means for giving an opportunity to our participants and to be a part of our FDP, 1 week FDP, sir. Thank you. And once again, I welcome you, sir.
So thank you very much for such a kind and a big introduction. Let me share my screen first and let's proceed. Okay, I guess my screen is visible to everyone, right? If anyone can confirm.
Yes, sir.
Okay, great. So again, thank you very much to everyone, Mr. Dhananjay sir, Jyotsna ma'am, for giving me this opportunity and also giving my introduction very well and brief. I would also like to welcome all the participants, and I would like to express my sincere gratitude to Department of MBA Narayana College to giving me this floor where I can explain and where I can share my all the knowledge, what experience I have. So today's topic is very simple. I guess you all are communicated that India's derivative market, a trader perspective. So we all know about the derivative, or probably we are curious to understand what is derivative and how we can make money out of it, right? So let's begin with today's program. If any question you have, you can raise your hand anytime during the session, or if you want to put any suggestion or a question in chat box, you are allowed to do. And we will this seminar or this webinar, it's not like a one-way things. I would really appreciate if we can create a communication kind of a like interaction kind of a seminar. So this is what my introduction. It's already been given. Myself, Kiran Jani. I'm a commerce graduate. 10 plus years of experience I do have. Currently, I'm working as an head of technical analyst at Jainam Broking. Previous to Jainam, I worked with Axis Security for the commodity assessment and ads. My core work remain under technical analyst and derivative analyst, and I regularly appearing on CNBC Bazaar Gujarati and ET Now Swadesh. So let's now talk about today's webinar, or maybe today's agenda. So after this session, all participants should know that what is derivative. There are different types of derivative. Then what those different types of derivative. We will discuss about the terminology and meanings also. Probably you are hearing so many words related to stock market, related to the derivative. So we'll decode all those words also. And if time permits, we'll discuss about the trading process. Like if you learning about the stock market and if you don't know how to trade, or you don't have any process, or you don't have any system to trade, then it is not worth it. So this session is something very practical session. I will put very less time on the theory and I will put more time on the practical. But if any problem or if any question you have during the session on derivative side, you please ask me. So this is what the basic introduction of the derivative, right? And this is a textbook definition of the derivative. The derivative is a one financial instrument which is derived or depend on certain asset, right? So this asset can be your land, this asset can be your equity, this asset can be your commodities. So generally derivative is a one kind of a financial instrument, or in layman language, we can say it is a one kind of a commitment. So you are committing something today for the future action, and in upcoming time, where whatever the timeline or duration is decided at that particular day, you perform that particular action. So for as a layman language, for a layman, you want to understand derivative. So in regular life, we are dealing in the derivative, but unconsciously we never know that what is derivative. So say for example, you want to buy a home, or you want to buy a land, or you want to buy any of the property. So what generally happens in market, that you visit, if you find suitable that property to you, you give them a certain money in starting, that is we call down payment. After that, what happens, a certain time has been given to both the parties. Like if I am a buyer, then I have a certain time to pay entire amount of the property. During after that time, paying all the amount, the property possessions or the ownership will come under my name. That is called the delivery of the product. So the same thing is happening on the derivative. This is entire derivative contract itself, right? But let's understand more of the derivative after this like example. I hope that you people can understand what is derivative. Let me give you another example of derivative is our insurance policy. So say for example, insurance company is giving commitment that if certain things happen, say God forbid I am taking an mediclaim, and if something happened, the insurance company is committed that this illness has happened, then we will pay your hospital bills. Against that commitment, I am paying certain things or a certain amount, that is called premium, right? So this is a two different derivative, but this is how the derivative market is running. In our regular life, we are also dealing with the derivative, but we never know that it is a derivative. But now I hope you can understand that these are the types of derivative. So here the derivative market, there are two types of derivative market. One is the exchange traded derivative and another is the over the counter derivative. So exchange traded derivative, there are two types of exchange traded derivative. Is one is the future and another is the option. And over the counter is like forward, a swap, collar and everything. So we will understand future, forwards and option, all three markets. Swap and collar will not touch because it is very difficult to trade. Even forward market difficult to trade as a retailer. Forward market, swap, collar is all for the institutional person, and it is also a OTC market, and we don't have any access to OTC market as a retailer. So we'll focus more on the future and options only, but for the understanding we will understand forwards, then futures, then options. So like here we go with the forward market. So forward market is a customized contract between the two parties where settlement take place on the specification on the specific date in the future, today's agreed price. So say for example, as I give you the example of the buying a property. So today you are agreeing with certain price, okay, by XYZ price, I want to buy certain property and will give you money by this month or maybe by this year. After that, you are going to deliver, right? So this is the pre-agreed price between two party only, and settlement take place on specific date that we have decided particular date. So this is how the forward market is happening. So forward market is a bilateral contract, right? Now in bilateral contract, there is an always a counterparty risk, and we are also facing something in our current situation. Like we want to buy a property, certain things happen, we couldn't make out the payment, then we defaulted. Now what happened to seller? We never know, right? The same thing happened if we bought something, but they couldn't able to deliver us, then it is called the counterparty risk. Again, the contract is very customized, and like contract size, expiry date, or maybe the asset type, quality, quantity, all are very customized. It is dealer to dealer market. That's why it is trading on the OTC market, not on the exchange, right? As I mentioned, that contract, the price of is not available on the public domain. It is between the two party. It's a trailer made contract only. Forward market always settle with the delivery. If there is a no delivery, there is no, it is not called the forward contract. If there is a forward contract, delivery has to be there. So buying a property, or maybe I can say farmers generally use the forward contract. So say for example, I am not a farmer, but I think that this crop or maybe that crop is going to be very less and the prices is going to rise. So I will go to the farmer and ask them, so whatever the crop will happen, you give it to me, I give you certain amount, right? And at time of harvesting, I will take all the crop. So this is called a forward contract. I am doing this contract now, but the performance of the contract or the execution of contract will be in the on the future date. And on that particular day, we have to settle with the delivery. If there is no delivery, it means the exchanging the asset against the money, exchanging the ownership of the asset also. In case of party, if both the party wishes, then only the contract reverse or maybe delivery or certain things will not happen. Otherwise, delivery has to be there. So this is how the forward contracts take place. Buyer is there, seller is there. They both decide as per their needs, quantity, price, duration of that particular contract, everything. There is no clearing house, there is no banking intermediary, or there is no initial margin, nothing called that. It is a dealer market only. So in this market, always there is a counterparty risk. If party is denied to perform the contract, then you don't have anything. You just have a contract you can enforce with the law. And sometimes people are not that much available with the contract also. So forward market is little bit risky to trade. Also, as a retailer, we never able to trade the forward contracts. Now, this is the future contract. So future contract is the exchange traded contract, and as and when the exchange comes, it is a standard agreement between the seller and the buyer. So as I mentioned, seller standardized agreement. So in agreement, everything has been mentioned. So what those things are being mentioned, that the date, right? A certain date of the future. So when this future contract is going to expire, that is the last date of the future called the expiry date. then the delivery date or the final settlement date. So in future contract, the delivery is not compulsory. Probably it can be the cash settle also, and probably it can be the deliverable also, right? And how to derive the future price? So it is a simple formula. Whatever the spot price is running, you have to multiply with the risk-free return, and you have to adjust with the duration of that particular duration of your contract, right? So let me give you the example of the exchange traded futures. So say for example, Nifty. So Nifty is an index. I hope you all understand what is Nifty. So Nifty is an index driven by the NSE, National Stock Exchange. Nifty is a 50 stocks combination. The broadly, when the market is going up and down, we can identify from the Nifty that if Nifty is plus, probably market is plus. If Nifty is minus, probably market is minus. So Nifty 50 is a one kind of an index where we can gauge the idea of the Indian market. So if you want to trade Indian market and if you want to trade index, you can trade Nifty. Bank Nifty is like another index. So let's take example of Nifty. So you want to trade Nifty. So Nifty is same for everyone. There is a certain last date of future that is called the expiry date. So today was one of the expiry. So in Indian market, what is the expiry? The expiry is the last Thursday. Expiry is the last Thursday of the month. If last Thursday of the month is holiday, then previous day of that Thursday, it's your expiry date, right? So 31st March today, the financial year is ending with the same day. We have a expiry of March month also. Now the lot size, the quantity. Lot size means the quantity. So if you want to buy a one contract of Nifty, it's become your 50 contract. So 50 is the lot size, right? So expiry date is fixed, lot size is fixed, and this is a standard contract. You buy from India, you buy any corner of India, it is remain same. Even if you want to buy outside of the India, it's remain same. So this is how the derivative, the future derivative traded. Here it's an exchange traded. So we have a two different intermediary are there. One is the exchange and another is a clearing house. So clearing house and exchange work hand to hand, and there is an also a broker is involved. So like we want to trade in Indian market, we cannot deal with the NSE directly. We have to open our account as a broker in broking account. Then a member broker can only trade on behalf of us, right? So say for example, I am from Jainam Broking. Then Jainam Broking is a one broker. We have membership of NSE, BSE, MCX, NCDX. Now you are a client, you come to us, you want to trade in Indian equity market, then you have to open your trading account and the demat account with us. Then after you can able to put the order, whether you want to buy a Reliance, whether you want to buy a Nifty, Bank Nifty, any of the shares, right? You can buy it. Similar way, there is a counterparty that is called seller. You want to buy, then someone has to be there to sell. So the process is same for the buyer and the seller. Now in exchange traded fund or maybe in future contract, what is the main benefit? The main benefit is there is an intermediary, right? There is a clearing house, there is an exchange, everything is there. So you are not directly trading with, or maybe you are not directly in touch with the counterparty. So I never will come to know that whose Nifty I am buying, right? Probably you are selling and I am buying, but we never come to know that you are a seller and I am the buyer of your Nifty. The same way I want to sell 100 Reliance, then who is buying my 100 Reliance? We never know. It is like I am dealing with the clearing house. Clearing house is dealing with the other party, and the clearing house is only the responsible person to get the delivery, to get the cash and exchange it. So here delivery, the clearing house, here the exchange is taking the responsibility of the settling of this contract. That's why there is no counterparty risk in the future market. I hope it is getting clear. If any question, you can put on the chat box. So now there are the few of the terminology. By looking at this terminology, we'll get more idea about the derivatives also. So there is a bullish and the bearish. So bullish, it's like a teji, or we can see prices continuously moving up. That is called bullish market. Now what is bearish market? So bearish market is when the price is continuously coming down. That is called mandi or the bearish market. Exchange. So what is exchange? Exchange is the place where buyer and seller are meeting. So in this financial market or in this digital market, there is not exactly a place. Generally, we have seen the fruit market or the textile market or a diamond market where people generally meet there and exchange their goods and money. But on the digital platform, we have a digital terminal where everything is available. After opening a account with the broker, you will able to open your terminal. On that terminal, you can get to know all the details, the share name, the open price, high, low, close, the running price, what is the volume, everything is there. And then you can able to perform your trading also. So that is called exchange terminal and everything. And exchange is the only responsible to create this market. So they have a broker, they have a sub-broker's client, broker's client. This kind of a business model is running out there. Then the settlement. So settlement, as I said, the like what is the settlement? So there are two types of settlement. One is the cash settlement, another is the exchanging the ownership, right? So in future market, there are few contracts where there is only the cash settlement is available, and there is few contract where the ownership can be changed. Now coming to the margin. So as in first example, we understood that you want to buy a land. So by buying a land, you have to give some money, right? That money we called a down payment, right? So here in future market, if you want to perform any of the contract, you have to pay certain money, that is called the margin. That is minimum requirement given by the exchange. If you are not paying certain margin, then you are not able to perform any of the trade. So margin is the collateral kept by the trader with the broker to cover the risk of losses on the transaction. In layman language, as I said, it is a general deposit initially has been given. Now long and short. So generally in derivative market, people said, okay, I am a long on security or I am a short on security. Where in equity market, you have heard this word, I am a buying or I am a selling. So long, it means you are buying something or you have a very positive view on that particular security or the asset. Where short means you are a sell or you having a very bearish view. We are expecting prices to go down. So here one thing we have to understand about the derivative, right? So derivative is one of the instrument. It is called the recession proof. So why I am saying it is a recession proof? Because say for example, today you are feeling that market is going down. Then if you holding certain stock, what you can do, you can go and sell it. If you are not holding any of the share and still you feel market is going down, what you can do, right? You want to encash certain things out of that, but you can't do anything because you don't have anything to give a delivery only. But in derivative market, you can go and short sell. If you do short sell and prices go down, then you make the profit. Let me give you example. Say for example, Nifty is quoting somewhere around 17,000. You feel market will go up. So what you can do, you go and buy Nifty at 17,000. If went up to 17,500, then 500 points per lot. So one lot is equal to 50, 500 points you make, right? So 25,000 rupees of profit you are making. Now at 17,500, you feel Nifty will go down by any reason, by any research you are doing, you think Nifty will go down. Then what you can do? You can short sell also, right? You don't have anything, but you of course you require money for that, like margin and everything. So once you have money, you can go and short sell that particular thing, right? You can short Nifty. So if you are shorting Nifty at 17,500 and rate is coming down, then you are making a profit. So derivative, we can say it's a recession proof instrument. You can use it very well. It is a one hedge asset also that will come on later part of this presentation also. Now, mark to market. So what is mark to market? So mark to market is the one kind of a system where buyer and seller has to nullify their trade, or they require to settle their trade every day, right? So it is a very good system, mark to market. Due to mark to market system, the counterparty risk or the default risk is getting minimized. Now spot price. So generally spot price, it means you want to take delivery immediately, then what is the price? So that is called the spot price. Now premium and discount. So whatever you want to buy at immediately now, and you want to commit that I will buy certain thing at after certain time, then there is a call difference between the delivery. You want to take delivery at 1st April, or you want to take a delivery at 30th April. So by finance student, I hope we all can understand that if you want to buy, you want to take delivery right now, then you want to give money right away, right now. If you are not paying right now and you want to take delivery later part, then the difference of this, it is a risk-free return, you can make it. So that risk-free return becomes the premium amount. So that is the premium and discount. So always your spot price is 100 plus your risk-free return. That's become your premium to pay a later part of particular duration. So this is how your spot price and the premium is defined. So generally in normal view of condition, all the futures traded at the premium only. We have seen certain situation where the price is traded at discount also, but in those situations we have seen the lot of fears, like sentiments is very negative, everything be there. Otherwise in normal due course condition, we have seen generally derivative market traded as the futures only. Now what is the calendar spread? So calendar spread is the difference between the two expiry. So say for example, I feel that market will remain up by April, but it probably come down in May. So I can buy April and sell May. So this is how I can create the calendar spread. So generally calendar spread trading being done between two options only. So again, more terminology, and these are the participant also. This is not only the terminology, but the participant. So who trades derivative market? So there are three types of participant who trades derivative. One is the hedger. So hedger generally having an exposure in particular asset, and to minimize the risk, they generally use the derivative product. Let me give you the example. Say for example, you are a jeweler and your business to sell the jewelry. So if you want to sell the jewelry, you require to procure gold. You do some work on that particular thing, you create the ornaments, and then you are selling. Now you procure gold at, say for example, 50,000, and you put some labor, you put some direct labor, indirect labor, packaging, furnishing, everything. The 10 gram which you bought at 50,000, now it cost you 51,000, and you want to sell it. So of course, if 51,000 is your cost of goods sold, then you probably like to sell at 51,500 or maybe 52,000, right? Depend on your profit margin. During this time, if gold price is coming down, say for example, when you bought gold, the price is traded at 50,000. When you made these ornaments, gold price become 49,000. So now at 49,000, you can't ask 52,000. If you ask 52,000, no one will purchase from you, right? So now you are at risk. You genuinely has bought this thing at 50,000, but because the prices is down, you are at risk. You are not making any profit. So generally, like gold manufacturer or gold jeweler do this thing. When they procure certain inventory, they go on the exchange and short sell particular things, particular contract, right? So during that, if prices go down, then on the exchange they make the profits. Now this is so hedger is to minimize. So there is a misconception also. People think by doing a hedging, by doing hedge, they can create a profit. So no, it is not like that. Hedging is just to reduce your risk. Like if you are making a profit by doing a hedge, then it is a purely your luck, but there is nothing certain strategy where in hedging you are making the profits. Now let's come to the arbitrage. So arbitrage is like one of the safest trading, we can say. So arbitrage is just a difference between the price. And why there is a difference? Because both the market are different. So let me give you one example. Say for example, I am sitting at Surat. Something is like gold is selling at 50,000, and someone is sitting in Mumbai where the gold is selling 52,000. So this is a common understanding. If something selling higher rate, I can purchase at lower rate and selling at higher rate. So this is called an arbitrage. So buying and selling contract or a trade happen simultaneously only. So say for example, I am buying gold at Surat and I am saying Mumbai people that I can give you gold at 52,000 or maybe below that 51,500. Then the buyer may ready, then I can tell him that I can deliver gold in 5 hours, right? So if if he is agreed, then I can buy at 50,000. I can reach Mumbai in 5 hours. I can deliver gold at 51,500 and return that. So if I include those expenses also, then again I am making 500 points or 500 rupees per 10 gram. So if the quantity is big, I can create a big profit also. So this is what the arbitrage. Now coming to the speculation. So speculation is normal course of condition where people generally speculate the market. So as I said, if you think Nifty will go up, if you think Nifty will go down, the Ukraine and Russia things are going on. The Federal Reserve is about to hike the rate. Even in our India, we are seeing the inflation is rising. RBI is supposed to raise the rate. So these kind of things are happening. So these all are the negative sentiments. So you probably think that equity market will not perform, and go and short the equity market. So this is called the speculation. You are using the leverage because in derivative market, a future contract is inherently become a leverage product. Like you have to give a very if you want to buy a home of 1 crore, then you are not able, you are not supposed to pay 1 crore at a stretch. You have to give a very nominal amount, say for example 10%, 20%. So in Nifty also, if you want to trade 17,000 rupees of product into 50, then your whatever the your this margin contract, your contract size is 17,000 into 50, right? So it is close to 8 lakh rupees. So you are not supposed to pay 8 lakh rupees. You are supposed to pay only percentage of that 8 lakh rupees, which is 10%. So 80,000 has to be in your account and you can trade your future contract. So it is a leverage product. You are buying and selling 8 lakh rupees of contract, but by paying only nominal account. So that how to calculate those margin and contract value, this will come in later part of this session. So now let's talk about the option. Option is very good tool. If you want to start your trading career, this is the best instrument to trade also, right? Here we will understand what is option. We will also understand if you want to start trading, then how to trade also. So if we give derivative theory, everything, then you probably get bored. So now this is the last slide of the theory. Post this slide, right, or post this option thing, we will discuss about the trading. If you are very fascinated or passionate about the trading, then hold on and stay tuned. This is almost we are ending the theory part, and then we will move to the pure trading or maybe pure practical way. So what is the option? So option itself and giving an option to the party. There are always a two party, buyer is there and the seller is there. So buyer has a certain things and seller has a certain thing. So buyer has a right and seller has an obligation. So this is how the option contract created. So there are two types of option. One is call and call option. So what is call option? A call option gives holder right to buy a share. Means if I am buying a call, then I have a right to buy a share. And whoever is selling the call, he has a obligation on me. If I say I want that particular share, then he has to give, right? So option call buyer has a right and call seller has an obligation to deliver those shares. That is a theoretical. Now if I want to understand particular call buyer and call seller, then what is his or her view on the market? That is important, right? So if you are buying a call, it means you are bullish on the market. If you are selling a call, it means you are bearish on the market, or you think that market won't go up, right? So say for example, you want to buy a Nifty call, it means if you are buying a call, it means you are bullish on the market, and if you are selling a call, it means you are bearish on the market. There is another option. It is called a put. So when you buy a put, you have a right to sell. It means you want to give delivery something, you can buy a put. If certain thing happen, you can decide whether you want to give a delivery or not, right? So buyer has a right and seller has a obligation. Now, if I say you are buying a put, it means you are a bearish on the market. And if I say you are a seller of the put, it means you are the bullish on the market. So when I say call, you are buying a call, it means you are expecting market to go up. If I say you are selling a call, it means you are expecting market to go down. In simple way, if you want to buy a put, it means you are expecting market to go down. And if I say you are buying a, you are selling a put, it means you are expecting market to go up. This is what the traders language. This is what the traders language. Now, the option trading happen at the premium, right? So the maximum loss and profit of the option buyer or option seller is different, right? So when you are option seller, so as an option seller, price can go up anywhere, but for the downside it is a limited. So say for example you are selling something at 100 rupees, it can go at 0 only, it can't go in minus. So maximum profit of seller is 100 rupees, but you are buying something at 100 rupees, it can go up anywhere, right? So unlimited profit can be for the buyer. So there is the risk profile, it's clearly identified. If you are option buyer, you have a limited risk. If you are an option seller, you have an unlimited risk. Let's understand the terminology of the option. So option buyer, you always acquire the right and he is paying the premium. If you are option seller, then you have an obligation, you receive a premium, and that is only your income, right? That is only your income. You can't make anything more than that. What is the contract size of the option? So options contract size is equal to your lot size into your premium. And what is the option contract? Then again your lot size into your premium. Now strike price is very much important. So say for example, strike price is the regular interval, or we can say exercise price. And based on exercise price, option premium has been decided. Now there are two types of, again, an option. It's one is an American option and one is the European option. So American option exercised by any time during the contract, during the expiry day, before the expiry day also. But in European contract, it has to be expired at expiry date only. In India, only European option is trading. No American option are trading into the India. So this is very like very much crystal clear summary. As a trader, if you want to understand option, then it is very simple to understand. Say for example, you are buying an option, then call option, you have a right and you are a bullish. For the put, you are a, if you are buying a put, then you have a right to sell and you are a bearish. What amount you pay, that is called premium. You are paying a premium. Here your loss is very limited to the premium. Whatever premium you pay, that is your loss. Now you are selling a call option. It means your obligation to sell and your view on the market is bearish or flat. Either market will go down or stay remain there. Then only you can make profit when you selling the option. When you selling the put, it means you have obligation to buy. If market goes up or remain there, then only you can make the profit, right? Now, if whenever you sell the option, you receive something that is called receiving the premium, and that is only your profit. You can't make anything profit. So simple, option buyer has a limited loss, unlimited profit. Option seller has a limited profit, unlimited loss. So now you have to decide at which side you want to sit, at option buying and option selling. I generally prefer to be side of option buying only, and we'll discuss option buying strategy from now onwards. Any problem or any question till now in theory part, you can ask me right away, or we will go with the practical session. You can go, you can write in the chat box yes or no, or your question. No question? Shall I move? Okay. Great. So let's proceed. So now this is very interesting things going to be start. I hope you all will like this. This is the moneyness. This is again a theory part. For call option, the price has to come, that is called out of the money. The price is running, that is called at the money, and price is already passed, that is called in the money. So say for example, Nifty is quoting or Nifty is trading at 17,000, then 17,500 is about to come, so that is called out of the money. 16,500 is already passed, so that is called in the money, and 17,000 become the at the money. For put, the exactly vice versa. So 17,000 it's at the money for call and put both. In call, the price which about to come, that is out of the money, but in put, the same price will become in the money. So say, as given in example, 17,000 is my spot price, then 17,500 for call, it is out of the money, but for the put, it is in the money. The same way, 16,500 is in the money for the call, but out of the money for the put. So moneyness is very much important. When you're doing an option trading, the main crux is this only. The selection of the strike price is very much important. If you are not select a proper strike price, then even after your view is perfect, your view is right, then even you can't make profit. So say for example, you are very much bullish on Nifty, you bought 17,500 call in month of March, and today the expiry happened or the last day settlement happened at 17,400. Market came all the way from 16,400 to 17,400. The 1,000 point of rally came, but end of the day, you are making a loss. You predicted very well that market will come up, but the selection of the strike price was wrong. You bought it 17,500, and this was the reason you are not made the profit. So selection of the strike price is very much important, right? So the question is that what should we know before trading the option? So basics of the option, like what we have understand call and put. We understood what is call, what is put, why we are buying call, why we are buying put, that we understood. Now moneyness, in the money, at the money, out of the money, we understood that also. Now, if anyone want to trade into the option, what is required more? Then he probably required the view, whether he is a bullish, bearish, or a sideways. He thinks market will go up, then he buy call. If he thinks market will go down, he buy a put, right? By doing this thing, he required to identify at the money, out of the money, in the money. Based on that, he need to understand the option strategy. He need to understand Greeks and all. And with that, all the knowledge, he also required a big capital, right? Option trading is not easy. Everyone say option trading is very much complex. Option trading is also expensive. You require a lot of margin, lot of capital to trade this option, right? So this is what the discretionary trading. This is what we call discretionary trading. Today you are bullish, you probably buy a call. Tomorrow you are bearish, probably you buy a put. So when you are bullish and when you are how you become a bullish and bearish, that's depend on your mood, probably that's depend on the sentiments, that depend the sentiments around you. Probably you are using technical, fundamental, any of the two. Based on that, you decide your own view, whether bullish, bearish, sideways, anything, right? So this is called discretionary trading. So this is called discretionary trading. Based on your discretion, you decide the trade. Now, is there any simple way to trade option? Like whatever I have discussed, it is like very much complex. Like itna mere ko kaise yaad rahega, itna main kaise kar paunga. So there are a lot of things. We think that option trading is very much complex. The question remains same. So in many session, people ask me, is there any simple process to trade in option? My answer is yes. The basic requirement options that already we discussed, the basic understanding of the charting, right? If you don't understand what is technical analysis and all, doesn't matter. Then even you can trade into the option. Only a small capital is required. So let's understand that how your small capital you can compound and you can create a more profit. So before that, this is one of my favorite quote, that people think that derivative trading process is very much complex. So no, we will give you a very simplified version over here. In last 15 years of experience in 16 words, you can buy uptrend, you have to sell your downtrend, cut your losses, ride your winner, manage your risk, eliminate your bias, and stick to the plan. If you follow all these 16 words, you end up with making profit only. What happened in discretionary trading? Today the sentiment is very bearish, or maybe you are not confident on particular trade. You miss that trade. So greed, fear, no discipline, backtesting is not there. So these are the disadvantage of the discretionary trading, and these all disadvantage become the advantage for the system trading. When you do option trading, when you do system trading, then you can backtest. There is no emotion, because buy and sell rules are very much very much clear. If certain things happen, you have to buy. If certain things happen, you have to sell. So no emotions are there. Disciplinely you can maintain, and you can follow certain strategy also. So system trading is the very much important at beginning of your trading career. If you start doing option trading, system trading in beginning of the year, then the experience as a trader is very much important, right? So here is the one of my option strategy example I am displaying you. This is like 5-minute time frame chart we are going to present, right? When we going to do this trading, we're going to do this trading all the day. We will not leave any of the day, like Friday, Monday, Tuesday, Wednesday, Thursday. All the day we will do this trading strategy. Which instrument to trade? हम कौन से instrument पे trade करेंगे? So near weekly expiry. So there was a time we have only one expiry, that is called monthly expiry. Now we have a weekly expiry also. So we trade weekly expiry, right? Now, how to select the strike price? So strike price is very much important, as I mentioned earlier. So in this system, strike price selection is very much dynamic. So let's understand this. Oh, where is the notation? So here, let's understand. So what I have mentioned, based on every 5 minutes, we have to round up. So every 5 minutes, we will check the spot price of the bank nifty. Based on that, we will decide what is the strike price. So say for example, at 9:30 a.m., the spot bank nifty rate is 35,010. Then if I use round down or round up, what would be the strike price? Say for example, 100 is the multiple. 100 is the multiple intervals time, the strike price. And if it is below 50, I have to round down. And if it is above 50, I have to round up. So in that case, 35,000 would be my strike price. Clear? So I'm giving you another example. You all participants need to answer me. At 9:45 a.m., if spot bank nifty is 35,140, then what would be my strike? Right? Everyone clear with this? 35,100 is my strike. Everyone, right? So except Rajesh sir, other has to answer this. At 10 a.m., my spot bank nifty is trading at 35,299. Then what would be the strike? Except Rajesh sir, other has to answer. No one? I hope the logic is not done clear. Right? So 35,300 would be the strike I need to trade. Clear? So it is a very clear. Every 5 minutes, I will check the spot price. Based on the spot price, I will do round up or round down. No, it is 35,300 because it is above 50. You have to check the last two price. If it is above 50, then you have to trade that way also only. Clear? Let me give you another example. Say for example, 10:05 a.m. Your spot bank nifty is, say for example, 35,240. In this case, 35,200 would be the strike. Sapna, I hope it is clear for you. Perfect. Right. So this is very easy to understand. Every 5 minutes, my system will check the spot price. Based on that spot price, it will identify the strike price. Round up and round down formula. As I mentioned already, that in bank nifty, the interval, the strike interval, it's 100 only. So let me showcasing you over here. 1 second. NSE India. If you go on NSE India, option chain is here. You can see, I hope my screen is visible, and you can see here bank nifty. So every 100 point is the interval, right, Venkat? Every 100 point is the interval. That's why we are rounding up or rounding down with the 100 multiple only. There is no 50. If we trading into the Nifty, then you can convert into the 50. Clear? Shall I move? Okay. So after deriving the strike price, what I am doing, after deriving the strike price, my system will go on the option chart. So as I mentioned in that example, so 35,000 is the first option. So 35,000 call and 35,000 put. Both the strike option chart, my system will check. Both RSI. RSI is one of the indicator. Okay. So this is how your stock will showcasing you. Just a minute. So say for example, I am saying 35,000 call. Today market was 36,000. So Bank Nifty, say for example, 36,500. So this is the 36,500 5-minute chart. So here you can see. So this is the RSI. So every 5 minutes my RSI will also check that if it is above 60, then only I will consider again. If it is not above 60, then my condition will not do anything. If it is above 60, then my system will check the Bollinger Band also. Right here is the Bollinger Band. So it has to be above the upper band of price. So this is how the chart in short look. When you check the Bollinger Band, when you put Bollinger Band on your chart, when you put RSI on your chart should look like this. Rest it is in PPT. No, we will not go in detail that how RSI is working. I will only using RSI here. So RSI and Bollinger Band, two indicators are there. Then what I have to do, once if RSI is above 60 on particular strike, call or put, then I will check my price has to cross over the Bollinger Band. If it is crossing the Bollinger Band, then I will buy above that candle's high. That candle's low will be my stop loss. And for the profit booking, what I will do, I will trail my stop loss at 1:1 and 1:2. So this theory part, you can take a screenshot of this particular slide. We will explain you everything in proper manner in example, live example. So this is the example from the 10th, just a minute, 10th March only. Where is the annotation? Do we have annotation in this? Okay, fine. Okay. So on 10th of March, why I have taken example of 10th of March? Anyone knows what happened on 10th on March? Anyone? What happened on 10th of March? 10th of March 2022. Okay. So let me give you example. Explanation. On 9th of March, there was a news that the ceasefire has been stopped and Russia is about to stop the war and all. However, it doesn't happen. It did not happen. But there was another thing also. Yes, perfect. Counting. Vote counting was there. On 10th of March, there was a result of 5 elections, state elections. Right. And in the morning only, before market opens, it was very clearly showcasing that BJP is coming with the majority in all 4 states. So out of 5 states, the 4 state winning by the BJP. And as we all know that in center, there is a BJP government. So if state government is also all BJP, then market generally likes this thing and market will keep moving up. So at 10:20 a.m., what was the close? Anyone can? What was the close? At 10:20 p.m., the close is 35,338. I am repeating again. At 10:20, here you can see the time. At 10:20, the close is 35,338. 338. Based on round up and round down, what would be the strike? If the close is 35,338, then what would be the strike price? Everyone, I hope it is getting clear now. 35,300 would be the strike price, right? It is below the 50, then I will do round down. So by doing a round down, 35,300 would be the strike price. So my system is checking 35,300 call and 300 put also. So here you can see 35,300 call. What is my RSI? My RSI is above 60. It is quoting at 80 level. So my first condition is meeting over here. What is my second condition? The second condition is my price has to close above the Bollinger Band upper band. So here you can see Bollinger Band upper band value is 213 and the close of that particular candle is 226. So it is closing above the Bollinger Band. So now I have to buy above this candle and my stop loss would be the low of this candle, right? Then I will move to the 1 minute chart for the better understanding. So this is the simple one. Above 230 I have to buy and 170 is my stop loss. Now I want to calculate 1:1 and 1:2. So let's take me this test of you. You all are the finance student. If you are buying something at 230 rupees and prices will come down and you are selling at 170 rupees, then how much loss or profit you made? I am repeating again. You are buying something at 230 rupees and you sold those things at 170 rupees. What is the loss or profit you made? 60.80. Okay, you took exact prices, right? If I'm buying something at 230 rupees and I'm selling at 170 rupees, then 60 rupees is my risk. Now, if I say whatever risk you want to take, you can sell it if prices go 1:1. So 60 rupees you willing to take the risk, and if prices go above by 60 rupees, you want to sell it. Then what price you would sell? What would be your target at higher price? 290. Perfect. Right? And if I say 1:2, so whatever risk you are taking, double of profit you want to make, then what would be the price at higher level? You have to add 60 again into the 290, which is 350. Perfect. Right? So here is very clear. If you want to calculate 1:1, is simple. 230.80 is your buying price. 170 point is your selling price. Then you are taking 60.80 rupees of risk. You want to trade as a 1:1, then 230.80 plus 60 point of your risk. So 291 is your first risk reward point where we will trail our stop loss. Now, when will we book? So prices will touch 2 of our risk, right? So we are buying something at 230 and 60 rupees is our stop loss or a risk point. We double of that and we add into our buying price, which becomes 352. So in this case, you can see my stop loss has been triggered. 170 is triggered. So how much point we lost in this trade? We bought something at 230 rupees and it got sold at 170 rupees. So what is our risk or stop loss? How much point we lost? Simple, 60 rupees we lost in this trade. Now let's move ahead. On same day, 1:40 p.m. You can see time here, 13:40. It means 1:40 p.m. The prices came down. Bank Nifty was up by 1500 point and it came down to negative itself. So it was a big crash happened on same day also. Like if we are trading that particular day or if we are sitting in front of the screen, BJP is winning like this landstand victory. They came in 4 states. How one can think about the selling the market or short selling the market, right? No one can think on that. But as we follow the system at 1:40 p.m., system derived the close price. Every 5 minutes system is running, but 1:40 p.m. we have a trade. So what is that trade? So 34,686 is the closing price of 1:40 candle. So can anyone tell me what would be the strike price here? 34,686 is the closing price. 34,686 is the closing price. Then what would be the strike price? 34,700. I hope all are understand this. Please participate in this thing. If you are missing this thing, then you are missing something very big. In upcoming slide, you will definitely ask me to repeat this thing. So I request everyone to participate in this. So here my closing price of 5 minutes, it's 34,686. I will round up these things and it will become 34,700. So my system will check 35,700 call and 34,700 call, 34,700 put. And what I am seeing here, that in 34,700 put, my RSI is somewhere around 68. So my first condition is meeting. What is my next condition? That Bollinger Band, upper band closing. So here you can see this candle. This is called signal candle. It is closing above the Bollinger Band, upper band. I have to buy above this high and my stop loss would be the low. So here the figure 192.50 is my buying price and 64.60 is my selling price. So let's take you on the 1 minute chart. Here those 5 minute candle, I have to buy at 192.50 and my stop loss would be 64.60. Can anyone tell me what is the risk point? How much point of risk we are taking? If I am buying something at 192.50 and I am taking stop loss as a 64.60, then how much point of risk we have? Anyone? So it is a simple calculation, 192.50 minus 64.65, which is close to 128 point. I am taking a risk of 128 points. And if I want to trail at 1:1, then my first target price would be 320. So here you can see, if I am buying something here, my price is rising up. And I am seeing here, my 1 minute close is 361.65. I reaches to 1:1. So my stop loss, which was at 64.65, it moved to the cost to cost. Now, after reaching at 361, if price came all down all the way back to the 192, then here I am not making any loss or profit, right? I am exiting at cost to cost. So transaction cost is only my cost. But you can see prices keep moving up only. So now I'm calculating 1:2. So for 1:2, 192.50 is my buying price. I am doubling of my risk, which is 128 into 2. So my final price or my profit booking price would be 448. So here you can see my closing of that candle is 453.70. So I am meeting my second target also. So I am closing my trade over here. So here I bought something at 192 and I am selling at 453. So how much profit we have made? You can calculate this way. So 261 point we have made, out of 60 point we lost in our first trade. So 200 point you have made on investment of only 192 points. So this is what the power of option. This is how you can make the profit. Let's see here. So that example is not just an example. This is the live trading terminal I am showcasing here. This exactly trade happened in my account. This is the first trade, 35,300 call, bought at 243 point at 10:25 a.m. It got stop loss at 170 points. Here you can see another trade happened at, here the time 1 o'clock and 45 minutes, bought at 192.50. My first stop loss was 64.65, which was cancelled because 1:1 meet. Then my final sell price is 469.94. So let's take the calculation. Here you can see 225 quantity I have bought it. So 230, the 60 point of risk into 225 quantity. So I am losing 13,500. My account is down by 30,500 M minus what profit I am making. So I have sold at 469.94, which I bought at 192.50, and my contract size or my quantity is 300. So into 300, So I am making profit of 83,000 M plus memory recall. That particular day, I have made 69,732 rupees of profit. Clear? What was my investment? So I bought 192.50 300 quantity. So my investment was only 57,000. So on 57,000, I am making 70,000 net, recovering my loss also. So this was the power of option. This was the power of the system. So probably by looking at this trade, you fascinated that let's start this strategy. But no, that is not the right way. Let's see the whole backtesting report. So this is the backtest report. So this is the 100% system trading. We have created the one system. It is a computerized system. We have an algorithm at place also. The algorithm is taking all the trades. So this is what the backtesting of the strategy from 2017 to till now. Bank Nifty, this system has generated 3,000 points. The system has generated 3,000 points. So by saying 3,000 points is very less, looking at the drawdown. So what is drawdown? So drawdown is the consistency loss. If my system start doing loss, then what is the maximum loss I have made? That is 1,800 points. So by making 3,000 of profit, I am losing 18,100 points. Then that is it is not a good strategy at all. Let's look at another statistics. The 17,000 trade all the way in 5 years I have made. Out of 17,000 trade, only 570 trade were in profit. So 34% strike rate is there. What is the highest profit? It is 700. What is the highest loss? Is 585. Consecutive win and consecutive loss. This is everything is pre-cost. So looking at this statistics, probably you feel it is not good strategy to do. But money management is very much important. So here is the money management. So what I have done, it is a simple thing. I have showcasing you that I am investing 60,000 per trade. Here I am doing a starting capital as a 20,000. So if I do all the trade with the 20,000 plus my drawdown, so whatever drawdown, whatever the loss will come, I will put add on. But every trade I will do with the 20,000 only. Then this is the result. If I keep doing all the trade with 20,000, then in 5 years I am making 4,40,824 rupees, and these are the post cost. I have considered all the cost, right? What is the drawdown value? Only 1 lakh rupee. Only 1 lakh rupees of loss I am taking. So what is my initial investment? 1 lakh rupee, 1 lakh into 1 lakh 3,000 is my loss amount, plus 20,000 is my initial investment. So which is close to 1,25,000. On 1,25,000, I am making 4,40,000. So 4,40,000 divided by 1,25,000. This is the percentage return. 352% return in 5 years. So let annualize. 70% return annually you are making. Here I am not compounded anything. It is just a simple return. We can compound it this thing also, but then it will giving you mind-boggling number. So I'm not doing that thing. It is a very simple strategy which I follow since long year. This is my equity curve, right? This is what my equity curve. So from 20,000 all the way, now I am firing order, or I am doing this trading from 60,000, right? I started my strategy with the 20,000. Today I am doing this strategy with the 60,000. So this is how the derivative or the option trading helping you, right? So this is my live side. Thank you very much for inviting me. Thank you for giving and sparing a time for this session. I hope this session enlightened you. I have tried to justify my view in this 1.5 hour session, where I can explain you the theory part also, where I explain you practical part also. I don't want to keep the entire session for the theory, because what I believe, either my knowledge or my wisdom has to translate into the trade only. If it is not happening, then it is just an illusion of the knowledge, and I don't believe in illusion of the knowledge. It has to be traded, right? And this is one of my favorite quote, that it is not whether you are right or wrong, that is important, but how much money you make when you are right and how much lose when you are wrong. That is important. So this my entire strategy is all about. When I right, I make big. When I am wrong, I am losing less. That is the only key point to winning the market. So now the floor is open for the question and answer. I will happy to take all any question and answer. Thank you very much. Okay, so one by one, let me take this question on the chat box. 1 second. That was excellent. Thank you very much for all the appreciations. And I hope this word is not just for the typing and you people actually has learned. I have one question on future. How do you calculate initial margin? Does it differ client to client? No. So initial margin calculated by the exchange, and it is a very simple formula for that. So say for example, your Nifty is 17,000 into your lot size is 50. So 8,50,000 is your contract or the exposure size. So based on this contract, exchange decide the percentage. So as of now, exchange taking 15%. So 1,27,000 rupees is margin required when you want to trade in Nifty. Now this exchange decide margin every day, regularly, daily basis, and it never differ client to client. It is same for all the client, whether a domestic client, whether the international or institutional client. All client has to give a same margin or has to comply with the same margin. Thank you, everyone. Thanks for the appreciation. Yes, if any other question, I would be happy to take. For more info, if you want to connect me, you can connect me on my Twitter handle. I have posted in chat box. So yeah, if any other question, you can ask me.
I have one small question, sir. Ranjani, sir.
Yes, sir.
So why this option volume is going heavily? Is most of the time in our Indian market, everything is concentrated towards options, particularly index options. Can you explain some of these things?
Right. So initially, so first of all, let me give you this information. I hope you have only that since last 3 years, NSE is the like a worldwide. We have a award that the highest exchange index trading exchange is the NSE since last 3 years. So this is the big achievement for the as an Indian or as an Indian exchange. So Bank Nifty is the highest traded contract worldwide. Now, why index options trading is very much in India? Because in India, people very less understanding of the delivery. People don't understand what is the physical settlement and what is the cash settlement. Right? In stock, there is a physical settlement. So generally, people avoid physical settlement. So that's why they are not doing a stock options. Now, in a stock, you have to have a very clear view. You have to have a very much research. Then only you can do a stock options or a stock future. If you bought something and overnight it went down by 20%, then you can have a very heavy loss. But in index, it is rarely we have seen that index open at 10%, 5% or 20% lower. So index is one of called as a safest asset class in the comparison of the stock. So that's why we Indian believe safetiness, and we are very risk averse people. So we do a lot of trading on the index.
Yes, sir. Excellent, sir. I think there is some more question on the chat box. What is the guidance for beginners in trading?
Okay, so guidance for the beginners, like you first understand whether you want to do, as you mentioned, trading only. So if you want to go for the trading, you should understand the tools of the trading. Say, for example, technical analysis is there, quantitative analysis is there. Based on your own interest, you decide your tool, whether a technical or this quantitative. After that, you have to understand, you have to fair understanding of the product. Say, for example, you want to do option, you want to do future, etc., etc. Then only you can start your trading journey. For trading, I can recommend few of the books like the technical analysis of the financial market written by Mr. John Murphy. You can read this book if you want to go for the technical.
So really excellent, sir. I request any observation by Dr. Rajesh Kumar, sir.
Thank you, sir. Good evening. Thank you, Mr. Kiran. In fact, it was an excellent session. While, of course, the area derivatives is not new, the approach you gave, the simplicity with which you explained, the demonstration what you made, and the strategies what you showed, this 5-minute strategy, how to check, how to identify the strike price, fabulous. Though it's for short duration, the value what added is excellent. It was truly an awesome session. In fact, we'd like to hear more and more from you, and hopefully shortly we'll get in touch with you for a few more sessions. Thank you, Mr. Kiran. Excellent session again. Thank you.
Thank you, Rajesh sir. Actually, I took 5 hours or 6 hours session to explain this particular strategy. The 1.5 hour is very difficult for me to explain all the things. And I hope I justified your time, everyone's time, and I deliver the way you want.
Yes, sir, exactly.
It was truly, of course, truly, yeah.
Exactly, because a lot of, actually, I wanted to conduct a 2-day workshop with Kiran Jani sir, because there's a lot of things to share and a lot of ideas and strategies. In the future, we will definitely invite Kiran Jani sir. And only thing is that this is such a vast subject, derivatives, and the type of practical approach is needed, because we are academicians who normally we lose in this the practical touch and the feel for the markets. So I deliberately wanted to have the practical aspect along with the teaching and research aspects. So being a stockbroking industry person, and who daily deals with the ups and downs of the market, volatility of the market, and profit and loss of traders, that only a person who is having skin in the game can really understand and know how the lakhs and lakhs of money is being traded in the market, crores of amounts.
Right, sir. Definitely, we'll look into if it is possible for you and me also. We will go for the live trading session also for your students for the better understanding in future.
Great, sir. Great, sir. Really, I appreciate it very much, sir.
Thanks.
And any other observations, comments, feedback, sessions from some of the other participants also, I very much invite from our esteemed participants. We have a lot of learned academicians in this group, sir. So I think they have put in the chat box many of their observations. Now, for the benefit of time, I request our HOD, Dr. R. Vani Madam, to say a few words or vote of thanks.
Good evening, sir. Rajesh, sir. Your way of teaching is very excellent, sir. Your way of justification, the vast concept within 1.5 hours, superb, sir. And it is very easy way to understand the total concept. It's very difficult concept, derivatives, with statistical analysis. Thank you very much, sir. Thank you.
Josna Madam, are you there?
Yes, sir. Yes, sir.
Yeah, I request Josna Madam to wind up the session by vote of thanks.
Okay, sir. Sure. Okay. On behalf of Department of MBA, Narayana Engineering College, Nellore, and all the participants of FDP, I would like to thank our today's resource person, Mr. Kiran Jani Garu, for spending his valuable time in spite of his busy schedule and sharing valuable insights, etc. Today, we are all got a very good knowledge regarding derivatives and the live trading experience also. And all the things, whatever covered in the today's session, that is wonderful. And thank you, sir. And thank you all. And one more thing is a sincere request that is from my side. Sir, if possible, please share the PPT. That is why I am asking, means it will be benefited to our participants, I think so. So that's why, sir.
Definitely, I will share the PPT. Dhananjay sir, we are in touch with you and will send it by tomorrow.
Thank you, sir. Thank you so much, sir.
Thank you very much, sir. Actually, no, I'm very happy to have you from Gujarat. Yes, that is a Gujarati. Gujarat is a fundamental place where this stock market, financial market, share trading is something like an agriculture. Because I had been there in IIM Ahmedabad for 6 months,
Right.
and actually I have visited your Ahmedabad University, and I have interacted with the students. The enthusiasm with which they have, and the natural way of financial markets, how they interpret. And I'm very blessed to have an expert from Gujarat, Ahmedabad. Ahmedabad, they say it's a very nice place. People are very encouraging, cooperative, and very nice people. We used to have a lot of chai outside. I am Ahmedabad. A lot of very nice people, sir. I'm very happy that you have blessed us with your session. We look forward to some other sessions in the future, because derivative is such a important and emerging subject and complex subject, no doubt. But how you have made it simplified, and with such a notional amounts of lakhs and lakhs of crores being traded, definitely we look forward to more interactions, especially with the students, sir. Thank you very much.
Thank you, sir, for acknowledging the entire Gujarat community. And like as you said, we don't have a blood in our body, but we have a trading in our blood.
Sure.